The S&P 500 bounced after the State of the Union, but is this rally real or is it a trap? If you're struggling to read these mixed market signals right now, you're not alone. In today's S&P 500 forecast, I'm going to show you a simple stock market trading strategy for navigating choppy, uncertain market conditions, exactly the kind of conditions that inexperienced traders often get wrong. We'll also do a full review of our active energy sector trade, and I'll walk you through 2 new trade setups to watch this week. Let's kick things off with the key market indicators you need to know right now. Starting with the market response to the State of the Union. Wednesday, following the address, the market traded on up, but will that hold? We went back and looked in the last market forecast, and we saw that after many State of the Union addresses, the market sold off relatively soon. If you want to go and study this on your own, I've provided this indicator for you. The link will be in the description below. It's totally free. You simply come to this page. You can add it to your favorite indicators or scroll down a little bit and simply click Use on chart, and it'll put it right on your TradingView chart for you. I encourage you to go back and look and see if the market doesn't tend to sell off shortly after the presidential address. Now, I don't know how much this has to do specifically with the State of the Union or more likely our seasonality calendar. If we come over and look at the composite performance of the S&P 500, specifically during midterm election cycles, you can see that coming into March, we tend to flatline, and even shortly after March into April and May, we begin a decline. We've been talking about that in several market forecasts. Now, every year we get a State of the Union address in January or February. So is it the State of the Union that impacts the market, or is it seasonality that impacts the market? It doesn't matter. What we know is we tend to start to see a sell-off in the market, especially during midterm election cycles. So we need to be prepared for that. That's creating downward pressure on the S&P 500. Coming back to the S&P 500, if we go to our MACD chart, we've been watching for a long time now bearish divergence. The S&P has been making higher highs, while MACD's been making lower highs, and that needs to resolve itself. As you would expect from the name bearish divergence, that typically creates a bearish bias. Now, one thing to point out here that's interesting, we do have a MACD that's getting ready to cross up through the signal line and might also cross up through the zero line. Specifically, those would be more of a bullish signal, but in the context of bearish divergence and the number of times that it's kind of faked us out in the past, I'm not putting a lot of optimism that that's going to drag the market higher. Now, one of the things that is providing some bullish wind beneath the market wings is software. Since Monday's close, software grew almost 5%. If we go back and review our relative strength chart that we were looking at in the last market forecast compared to semiconductors / IGV software, we said this needs to pull back. If we trade much higher, it's going to actually start trading left, and stocks can't trade left. These 2 last candlesticks are a result of software gaining some support. Let's go back to software, and it makes sense where it's finding some support. If we draw a line all the way across where we bounced, we'll see that once, twice, thrice, 4 times, 5 times, there's a gap back there. This $76.80 or so on software is a very strong long-term support. If that holds, that should be good for the S&P 500. If that fails, look out below. We don't know. It's at a pivot point right now. We need to wait and see how that resolves. But if we go over to the semiconductor friend of software, it too broke out of a recent resistance. This is good for semiconductors. And as the saying goes, as the semis go, so go the rest of the market. So is the market going to go up? Is the market going to go down? We've got seasonality. We've got bearish divergence. If it seems very confusing, it's because it's very confusing. It's uncertain. And the best thing to do is embrace that uncertainty and not pretend like you've got a crystal ball and you know exactly what's going to happen. Let's take on a bit of a teaching tone and talk about how you navigate these difficult market conditions. One of our instructors at Tradesmart University teaches this idea of trading hedged, which, let me explain this on a side-by-side chart of our energy trade on the left and a JP Morgan trade on the right. We talked in the last market forecast about how energy was so overbought. In fact, here's the trade idea that we had set up on that, ticker symbol XLE. And we got into this trade. It's very profitable, and I believe this is going to continue on to be profitable. So that's going to make money as the market goes down. But let's look at JP Morgan here. This is actually setting up to be one of my Fibonacci trades, which in this case would be a bullish trade. We're finding support. We've got stochastic that's coming down below 20. This would be a stock that I would be optimistic trades on higher. Now, what if the S&P 500 decides to just crash? It's probably going to pull our energy trade with it, which is going to be great. And it may pull the JP Morgan trade with it, which would be sad. But that's a hypothesis. It could be, as the market comes down, it pulls our energy trade with it. And then JP Morgan either trades sideways or maybe even goes up a little bit. That is a possibility. What's another thing that could happen? The market could take off on a tear and it drags our energy trade on up. And that would, of course, be sad, but it would drag our JP Morgan trade on up with it as well, which would be great. But it's only a hypothesis that energy would continue on higher. This is so overbought. It's possible that this continues to reset even if the S&P 500 were to find some new highs. This idea of trading hedged is finding stocks that have a strong probability of a directional trade in and of themselves, but are balanced. You've got some that are bearish and some that are bullish. And that way, if the market does decide to go on a tear, one of your trades should really benefit and the other might struggle a little bit. The best case scenario is both trades work out exactly the way you wanted them to. So let's go back and look at these individually. We'll update on XLE. If you're not in this trade, I think you still have an opportunity to get in this trade. We were looking at MACD earlier. There's a bearish MACD cross, the blue line crossing down over the signal line. That would be a bearish setup. Also, we looked on Tuesday at the moving averages and we said the energy sector is the furthest it's been in a long time, maybe ever, away from the 100 period moving average. And you could go and put the distance from moving average indicator, go back and look at Tuesday's forecast to get an update on that. I think this still has a lot of possibility to continue bearish. Now, with that said, we are nicely profitable on this. I would move my stop up to break even or just above break even if you're in this trade with me. And as we continue on down, especially as we get to about halfway here, this is going to be about $175 cash in your jeans. Keep locking that in. Move your stop all along the way. There's no reason to let a winning trade close for a loss. This is a great winning trade right now. Let's go back over to JP Morgan. This will be a new idea. I love the fact that we're bouncing off from the 200 period simple moving average. If we look back over JP Morgan's history, when we get down and interact with this red line, the 200 period simple moving average, it tends to be a support. In addition to that, I just drew the blue line support and we've got stochastic that's down around 20. I would prefer for this setup that it dips below 20 and then pops back up. So you might want to wait on this a day or two. In case we don't talk before then, let me just put some numbers on here. I would get into this trade around $302 or so. You could get in a little cheaper if the stochastic dips lower. I put my stop down below these wicks that dip below our support line there. So that's about 285.83. And then our target's going to be back up here at recent resistance. I wouldn't be too aggressive with it. There's another line right here that's acting as a resistance. And so I'd be thinking about getting out of my trade as you're approaching that resistance. That looks like about a 1R trade, just shy of a 1R trade, which if you're trading a full R on one of our funded trading accounts, that'll be $250 cash in your jeans. Now, I'm curious to know what you're trading. Go ahead and type the tickers of your most recent trades in the comment section, or if there's a stock that you'd like me to look at and review in this market forecast, type that in there as well with a note that you'd like me to take a look at your stock. Blessings and favor on your trades. I'll see you back here Tuesday for your next market forecast.